Hey everyone, something major just happened in silver, and if you blinked, you missed it. Silver hit a panic low around $64 and then ripped all the way back up to about 77.69. That's not a cute little bounce. That's a market trying to shake people out, then daring them to chase back in at a much higher price. And while that was happening, gold was quietly pushing up near 49.66, up about 4% in 24 hours. So the real question is not why is silver volatile? Silver is always volatile. The real question is, why did silver go from people are freaking out at 64 to everyone wants back in at 78 in what felt like the same breath? Because moves like that don't happen when everything is healthy. They happen when positioning breaks, liquidity disappears, and somebody with size takes advantage of the chaos. And if you own silver, or you're thinking about buying it, this is the kind of move that tells you the next decision point is going to matter a lot. What you're seeing isn't the mainstream explanation. Let me show you the three things happening right now. First, this was a classic forced move environment. When silver dropped into the mid-60s, it wasn't just investors changing their minds. A drop that fast tends to trigger margin calls, stop-loss clusters, and leveraged traders getting liquidated. Here's the simple version. A lot of traders don't buy silver with 100% cash. They use leverage, meaning they borrow buying power. That works great on the way up. But when price drops hard, the broker doesn't ask politely. They sell your position for you. So in a fast drop, you get this domino effect. Price falls, liquidations kick in, price falls more liquidations hit, and suddenly you've got a waterfall. That's why these panic lows feel like a trap door. It's not just selling, it's forced selling. Second, once you hit that kind of panic level, liquidity gets thin. And thin liquidity is where markets get weird. Thin liquidity means there aren't enough buyers and sellers at each price to keep things orderly. So if a big seller dumps, it can smash through multiple price levels. And if a big buyer steps in, it can vacuum price higher just as fast. That's how you get a day where silver looks like it's collapsing. And then hours later, it looks like it's launching. In other words, this was not a gentle, rational auction. This was a brawl in a narrow hallway. Third, the rebound itself is a signal, because it tells you there were real buyers waiting. Not at 78, not even at 72, but down near the panic zone where everyone's emotions are the loudest. And this is where the game changes. Because when you see a move from around 64 back to around 78, that tells you two things at the same time. One, weak hands got flushed. Two, stronger hands absorb supply fast. That combination, flush and absorb, is what often marks the transition from sell-off into new range. Not always, but often enough that you have to respect it. Now, I've been tracking markets long enough to tell you this. The most dangerous moments are when the market is moving so fast that your brain starts negotiating with itself. You start saying things like, I'll buy if it goes lower. Then it goes lower, and you freeze. Then it rips higher, and you chase. Then it whips back down, and you panic. That emotional loop is exactly what these moves are designed to create. Now here's what they're not showing on CNBC. The silver move isn't happening in a vacuum. It's happening in a broader metals environment where gold is still elevated, central banks are still buying, and investors have been pouring money into precious metals ETFs. So we have this weird split-screen reality. On one side, silver is acting like a high volatility risk asset, because it is. It trades like something that can get margin called and whipped around. On the other side, gold is acting like a monetary asset again. And that matters because gold tends to lead the narrative. Silver tends to overreact to the narrative. So when gold is holding up, and especially when gold is still being accumulated by official buyers, silver's violent sell-offs can turn into violent snapbacks. Let's talk about the institutional layer, because this is where most retail investors miss the real story. Smart money moved before the crowd noticed. When you see reports of strong inflows into precious metals ETFs, that's telling you there's still institutional demand showing up, even while the headlines are screaming, crash. And when you see central banks, especially China, continuing to add gold month after month, that's a structural signal. Central banks don't buy because they feel bullish. They buy because they're reallocating out of currency exposure and into a reserve asset. That's not a day trade. That's a long duration decision. And it creates this backdrop where dips get bought harder than people expect. Now let's get technical for a minute, but I'm going to keep it human. When a market drops hard and then recovers most of it quickly, it often leaves behind a psychological scar. People who sold the low feel sick. People who didn't buy feel left out. People who bought the top feel trapped. And what happens next is usually a battle around a few obvious levels. In silver's case, the level everyone is staring at now is that rebound zone in the high 70s. Because if silver can hold in that region and stop revisiting the panic low, the market starts to build a base. That's when you can get a new leg higher later. But if silver rolls over and starts slicing back toward the mid-60s again, then the message is different. Then the rebound was just a dead cat bounce inside a larger unwind. So what decides it? Usually it's a combination of rate expectations, the dollar, and whether liquidity stays tight or normalizes. Now look, silver is not just a money metal, it's also an industrial metal. That's why it gets hit so hard in risk-off moments. It has one foot in safe haven psychology and one foot in factory demand. And that dual identity is exactly why these moves are so violent. If the market starts worrying about growth, silver gets treated like copper's crazy cousin. If the market starts worrying about currency credibility, silver gets treated like gold's aggressive little brother. That tug of war is why silver doesn't glide. It lunges. Now let's talk fundamentals, the supply and demand picture, because this is what matters after the dust settles. The big story with silver over the last few years has been the industrial bid. Solar, electrification, advanced electronics, defense applications. Silver keeps showing up in the real economy. And here's the part people don't respect enough. Silver isn't consumed like gold. Gold mostly gets stored. Silver gets used. A lot of it ends up embedded in products where it's not economically recovered at scale, meaning it effectively gets removed from circulation. So when demand is strong, the market can feel tight even if price action looks chaotic. But, and this is important, paper market dynamics can overwhelm fundamentals in the short term. That's what you just saw. Fundamentals don't prevent a liquidation event. They shape what happens after the liquidation event. So the key question becomes, did this sell-off trigger long-term buyers to step in, or did it scare them away? And that's why the rebound matters. Because a rebound this sharp usually means somebody saw value and didn't wait. Now I want to zoom out because we've seen this exact pattern before. History is repeating itself. Not in the sense that the exact prices match, but in the sense that the sequence matches. Think back to periods like 2011 and 2020, where silver didn't move politely. In 2011, silver had that explosive run that turned into a violent break. It didn't top out gently. It ripped, then snapped, then chopped people up. In 2020, silver got smashed during the initial liquidity panic, then rebounded aggressively when the market realized the monetary response was massive. Different catalysts, same psychology. Stage 1 is always optimism. Stage 2 is leverage. Stage 3 is the shakeout. And stage 4, if it happens, is the move that rewards the people who survive the shakeout. Right now, what you just lived through feels like stage 3 behavior. The shakeout phase is designed to do one thing: transfer the position from emotional hands to patient hands. And if that's what's happening, you typically see 3 signs after the initial chaos. Volatility stays high, but the lows stop getting lower. Bad news stops pushing prices far down. And rallies start getting bought faster than dips. We're not done yet. I'm not telling you that was the bottom. Nobody can promise that. But I am telling you this: a move from around 64 to around 78 is not random noise. That's a message. Now let's make this personal, because this affects your money directly. If you're a normal investor and you have, say, 100 ounces of silver exposure, whether that's physical, a proxy, or a mining basket, this move is massive. From 64 up to 77.69 is about $13.69 per ounce. On 100 ounces, that's roughly $1,369. And if you had 500 ounces exposure, that's almost $7,000 of swing. In a very short window. That's why people get emotionally wrecked by silver. Not because it's hard to understand, but because it moves fast enough to trigger bad decisions. Now imagine you're not holding physical, but you're holding something leveraged or you're trading options. That kind of move can be life-changing in both directions. And here's the trap. After a rebound like this, a lot of people feel safe again and chase. They feel like the danger is over. But volatility doesn't end with one dramatic session. Usually the aftershocks are where the market does the most psychological damage. So the smart way to think about it is not up or down tomorrow. It's, what zone are we entering now? If silver can stop living in the panic zone and start building a new floor, then the conversation changes from survival to opportunity. If it can't, then you treat every rally with respect, because the market is still unstable. Professionals have been preparing for this, and one of the cleanest tells is what happens when everyone is scared. Do physical buyers show up? Do long-term flows continue? Do central banks keep accumulating gold? Because if that underlying bid remains, it puts a cushion under the whole complex, even if silver still throws tantrums. Look, the question isn't whether we see more volatility. We will. The real question is, are you positioned for what comes next? Right now, silver sits around 77.69, and gold is near 49.66. Those are the facts. The next week and the next couple of data points will help determine whether this was a capitulation flush or just the first break in a larger unwind. I share real-time updates and deeper analysis on social media. For those wanting exclusive research, members-only analysis, or early warnings, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations, but the data speaks for itself. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think silver is headed by the end of this month? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3. Next video drops tomorrow, and I'm covering the one indicator that tends to show up right before these silver whipsaws calm down or explode again. It's flashing right now. You won't want to miss it. See you there.